The largest bank failure has warnings for you. Don't believe the big banks blindly. They are never too big to fail. Welcome to Money Clarity Hub. In September 2008, one of the largest banks in the United States collapsed almost overnight. Customers lined up outside branches. Investors watched billions vanish. Regulators rushed into emergency meetings. And within hours, a financial institution that once held more than $307 billion in assets simply ceased to exist. But the collapse of Washington Mutual did not happen overnight. It was the final moment in a long chain of decisions, risks, and warning signs that had been building for years beneath the surface of the financial system. To understand what really happened, you have to go back to the years before the crisis, when the housing market looked unstoppable and banks were expanding faster than anyone imagined. Washington Mutual, often called WAMU, began as a traditional savings and loan institution. Founded in 1889 in Seattle, it spent more than a century operating as a relatively conservative mortgage lender. But by the early 2000s, the financial landscape had changed dramatically. Interest rates were low, housing demand was exploding, and banks were under pressure to grow quickly. Mortgage lending had become one of the most profitable businesses in the financial world. By 2006, U.S. home prices had increased by more than 90% compared to a decade earlier. To many investors and executives, it looked like the safest boom imaginable. Housing rarely fell nationwide, and mortgages were considered stable long-term assets. Washington Mutual wanted a bigger share of that booming market. Throughout the early 2000s, the bank aggressively expanded its mortgage business. It acquired smaller lenders, opened hundreds of branches, and marketed new loan products across the country. In 2006, Washington Mutual held more than $350 billion in assets and served over 9 million customers. It had become the largest savings and loan institution in the United States. Wall Street analysts praised its rapid growth. Investors saw a powerful expansion story, but beneath that growth, something dangerous was forming. The key driver was a category of loans known as subprime mortgages. These were mortgages issued to borrowers with weaker credit histories, lower incomes, or limited documentation. Traditional banks had once avoided these loans because they carried a higher risk of default. And this is where the financial magic started. Some people called it financial trickery afterwards, but that is how the financial innovation worked at the time. So instead of holding loans on their own balance sheets, banks started packaging them into securities and sell them to investors. These mortgage-backed securities spread risk across global markets and generated enormous profits for financial institutions. Washington Mutual moved heavily into this business. By the mid-2000s, the bank was one of the largest issuers of risky home loans in the country. It offered adjustable-rate mortgages with low introductory payments, loans requiring little or no documentation, and products designed to approve borrowers who previously might not have qualified for credit. Some loans allowed borrowers to make payments that didn't even cover the interest, causing the loan balance to grow over time. These were known as option adjustable-rate mortgages, and Washington Mutual became one of their largest providers. At first, the strategy looked brilliant. As long as home prices kept rising, borrowers could refinance or sell their homes before payments increased. The bank collected fees and interest while expanding its loan portfolio rapidly. Between 2003 and 2007, Washington Mutual issued tens of billions of dollars in high-risk mortgages. Profits surged. The bank's stock price climbed. Executives received bonuses tied to loan growth and revenue targets. On paper, everything appeared strong. But the system relied on a fragile assumption. Housing prices would continue rising indefinitely. When prices rise, even risky borrowers can refinance or sell before financial stress becomes visible. But if prices stop rising, the entire structure begins to crack. And that is exactly what happened. By 2006, the U.S. housing market started to cool. Home price growth slowed. In some regions, prices began to decline. At the same time, millions of adjustable-rate mortgages across the country were resetting to higher interest rates. Borrowers who had been making small introductory payments suddenly faced significantly larger monthly bills. Many households simply could not afford the increase. Mortgage delinquencies began rising sharply. In 2007, defaults on subprime loans accelerated across the United States. Financial institutions that had built large portfolios of these loans suddenly faced growing losses. Investors who had purchased mortgage-backed securities started questioning their true value. Confidence began to weaken across the entire financial system. Washington Mutual was particularly exposed. By early 2008, the bank held roughly $118 billion in option adjustable rate mortgages and tens of billions more in subprime loans. As housing prices continued falling, many borrowers owed more on their homes than the properties were worth. This situation, known as negative equity, made refinancing impossible and encouraged borrowers to walk away from their loans. Losses mounted quickly. In the fourth quarter of 2007 alone, Washington Mutual reported more than $1.6 billion in losses tied to mortgage defaults. The bank attempted to reassure investors that the situation was manageable. Executives argued that the housing market would stabilize and that most borrowers would eventually recover, but the numbers kept getting worse. By mid-2008, Washington Mutual had recorded more than $6 billion in mortgage-related losses. The bank's capital position weakened, and its stock price collapsed by nearly 90% within a year. Investors grew increasingly worried that the institution might not survive the unfolding financial crisis. Rating agencies downgraded the bank's debt. Analysts warned that its loan portfolio was far riskier than previously understood. Yet the real danger emerged not from losses alone, but from confidence. Banks operate on a fragile foundation of trust. Depositors place money in accounts expecting it to remain safe and accessible. But banks typically lend out a large portion of those deposits, meaning they cannot repay everyone simultaneously if panic spreads. When confidence breaks, even a large bank can fail very quickly. In September 2008, that confidence began to collapse across the financial system. Just days earlier, the investment bank Lehman Brothers had declared bankruptcy, triggering panic across global markets. Investors, depositors, and institutions began questioning which financial firms might be next. Washington Mutual was already under intense pressure. In the 10 days following the Lehman collapse, customers withdrew more than $16 billion in deposits from the bank. For any financial institution, such a rapid outflow is catastrophic. Deposits are the lifeblood of banking operations, and when they disappear at that speed, the institution cannot maintain normal operations. Regulators realized the situation was deteriorating rapidly. On September 25, 2008, the U.S. government intervened. The Federal Deposit Insurance Corporation seized Washington Mutual and placed it into receivership. Within hours, the bank's core operations were sold to J.P. Morgan Chase for $1.9 billion. It was the largest bank failure in American history and the world at the time. Despite the enormous scale of the collapse, most depositors never lost their money. The FDIC insured deposits and ensured that accounts continued operating under the new ownership. Customers were able to access their funds, use debit cards, and write checks without interruption. But shareholders were wiped out. Washington Mutual's stock became essentially worthless overnight, eliminating billions of dollars in investor value. The speed of the collapse stunned many observers. Just weeks earlier, Washington Mutual had still been operating thousands of branches and serving millions of customers. Yet the combination of mortgage losses, declining confidence, and rapid deposit withdrawals pushed the institution beyond recovery. But the collapse also revealed something deeper about the financial system itself. Washington Mutual was not the only bank exposed to risky mortgages. In fact, dozens of major institutions across the world held similar assets. The failure of one bank triggered fears about others. Within weeks, governments across the United States and Europe launched emergency rescue programs to stabilize the financial system. By the end of 2008, the global financial crisis had erased trillions of dollars in wealth. U.S. housing prices fell by more than 30% from their peak. Global stock markets plunged. Millions of people lost jobs and homes. The crisis spread from mortgage markets to the broader economy, triggering the deepest recession since the Great Depression. In response, central banks and governments intervened on an unprecedented scale. The U.S. Federal Reserve lowered interest rates to near zero and began large-scale asset purchases known as quantitative easing. Governments injected capital into major banks and introduced stimulus programs to prevent economic collapse. The goal was simple: restore confidence before the financial system unraveled further. Yet the story of Washington Mutual remains a powerful example of how quickly financial institutions can fall when risk accumulates beneath the surface. For years, the bank appeared strong and profitable. It expanded aggressively, attracted investors, and dominated the mortgage market. But the growth was built on loans that depended on continuously rising home prices. Once that assumption failed, the entire structure began collapsing. The crisis also exposed how complex and interconnected modern finance had become. Mortgages issued in local communities had been transformed into securities owned by investors around the world. When those mortgages began failing, the damage spread through banks, hedge funds, pension systems, and global markets. Even today, economists continue debating the lessons of 2008. Some argue that lax regulation allowed banks to take excessive risks. Others believe the incentives within financial institutions encouraged short-term profits at the expense of long-term stability. Many point to the housing bubble itself, fueled by cheap credit and speculation, as the root cause. But one lesson remains clear: financial systems often appear stable right up until the moment they are not. Risk can build quietly for years beneath the surface, hidden within complex products and optimistic assumptions. When the turning point arrives, the collapse can happen far faster than anyone expects. The fall of Washington Mutual was not just a banking failure, it was a warning signal about the fragility of modern finance. A bank with more than $300 billion in assets, operating for more than a century, vanished in a single day once confidence disappeared. And that raises an uncomfortable question. If institutions of that size can fail so quickly, what does that say about the stability of the system itself? So what does this mean for you? The collapse of Washington Mutual shows something most people don't think about when they look at big financial institutions. Just because something looks huge and stable doesn't mean it's safe forever. Banks can grow fast, markets can boom, and everything can feel normal right up until the moment it isn't. Understanding a bank collapse requires clear thinking. The Mind Decluttering Starter Pack helps you build that clarity. Link is in the description. The real lesson isn't that you should panic about the financial system, is that you should stay aware of how it works. Know where your money is. Don't rely on a single institution, a single asset, or a single narrative about how markets always go up. Crises almost never arrive with a clear warning label. They build slowly, quietly, while everything still looks fine on the surface. And the people who handle those moments best are usually the ones who understand that stability in finance is never permanent. Once you see that, you start making smarter decisions. You start paying attention. And that awareness alone already puts you ahead of most people. Because the truth is, financial crises rarely begin with a single event. They begin with a series of decisions, incentives, and assumptions that gradually push risk higher and higher. For years, those risks remain invisible. Growth continues, profits rise, markets appear calm, until suddenly they aren't. And when that moment arrives, the collapse can rewrite the financial landscape almost overnight. Again. Thanks for watching Money Clarity Hub. Keep your mind clear and your money growing. Subscribe for more practical insights every week and check our playlists for more clarity and growth.